Jimmy Vercellino here, mortgage originator specializing in VA loans, and today I'm going to share with you how to properly structure a VA loan. What exactly does that even mean, by the way? Well, it means that you want the monthly payment to fit. In addition to that, it means that you want the cash to close to be in line with your appropriate budget. Good to go? So before we get started, if you found that this information was of value, click like on the video, comment down below with your questions, and lastly, consider subscribing to the channel. So let's get this party started. Structuring a VA loan. What is it? How does it work? Why is it important? So simply stated, you want your mortgage or VA loan to fit. You want it to fit by way of monthly payment, and in addition to that, you also want it to fit by way of cash to close. Now, what that does not mean, veterans, is that you're just going to kind of walk into a mortgage shop or operation, as a result, just say, hey, give me a mortgage, and they say, okay, good to go, and now you're stuck with it. No, you as the veteran get to pick and custom fit, once again, the perfect lending solution for your individual needs. So I wanted to talk to you today about this idea of something referred to as a buy down cost. A lot of veterans don't know what that is, they don't know what it means, and they don't know how it works, and we're going to change that now. Good to go? Think of it like this: a buy down point, an investment into your loan at closing. Well, it means that you're paying money at the close of escrow to get a lower interest rate. Well, wait a second, Jimmy. I thought VA set the rate. Not exactly. Keep in mind that rates vary depending upon the day and the way in which you structure your mortgage. So I was prepared for this. Taylor told me, hey, have all of your stuff squared away, and that's exactly what I did. So I put together a little illustration or scenario for you here today that I think is going to provide you value. So we talked about this idea of a discount point. You may hear that terminology. And oh, by the way, special shout out to Jared, who talked to me about this, who watches this channel and who's currently under contract. We had this exact conversation. I told him I'd put it together for him and make sure to mention your name. So Jared, if you're watching, shout out to you for the idea on how to structure the VA loan. So here it is. Let's just assume, and these are hype scenarios, veterans, this is not me quoting interest rates, but let's just assume for a second that a veteran is purchasing a home for roughly $400,000 and they're financing that loan amount at 7%. The cost, or the monthly payment, $27.18, and the principal, well, this is based off of, I should say, principal and interest. Let's talk about how we structure this loan. Think of it like this: you want the mortgage to fit kind of like maybe this sport coat fits in the chest, fits in the arms. Same thing with the mortgage. You might say, well, Jimmy, that payment is a little bit uncomfortable for me. It's a little tight. So what you could do with your lender is you could essentially buy down the rate. So once again, a buy down is an investment in your loan to have a lower rate of interest throughout the duration of your mortgage. You following me along on that? So in this same scenario, you could buy down the rate to 6.5%. Again, hypothetical scenario, this is only an example, but at 6.5%, same loan amount, the monthly payment's different. It goes down. You following me along? So principal and interest, the savings between the two is approximately $135 a month. Here is what you, as the veteran, must be able to determine. Put it to you like this: is the juice worth the squeeze? So that's what we want to determine. And so this is what we refer to in mortgage planning as an ROI analysis. So it's pretty simple, it's pretty straightforward, but if the savings is $135 a month and the cost to buy down that rate is $4,000, well, we do a simple calculation. That calculation, 4,000 divided by 135 equals 29 months. 29 months, roughly 2 years and 5 months. So the question that we have to ask ourselves, veterans, is simply this. Number one, am I going to live in this home for a minimum of 2 years? If the answer is yes, it may be worth exploring buying down your interest rate. If the answer is no, this might surprise you when I say this, but sometimes taking the lowest rate can actually end up being more expensive if you don't break even on your investment. And especially if interest rates go down and there's an opportunity to refinance with less, you may have lost money here. It means that you need to make sure that you're working with a mortgage advisor who specializes in VA loans and can ensure that the loan is custom tailored to you and your family's individual needs. If you have more questions about anything VA buy down related, or heck, VA loan related, make sure to drop a comment down below and always reach out with any questions or concerns that you may have. I'm not hard to find. We'll talk to you soon.